From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. You're listening to the HPS Macrocast. Tony Fratto coming to you from the Pittsburgh area, Western Pennsylvania, and the Laurel Mountains this week. John Fagan and Brendan Walsh from Markets Policy Partners are you guys in the DC area still?
I'm on Cape Cod.
You're at Cape Cod, yeah. So I thought we were dispersing a little bit.
Yeah, I'm still in DC.
Yeah. And you're in DC, John?
Yeah, it's hot and gross.
But you got baseball, and I see you're sporting your Nats cap this morning. Tough loss last night to our Yankees. John, Dick, you're still a Yankees fan, right?
Nope, never.
Never.
not even a little bit.
I want to say I'm still a Red Sox fan. I'm just this is just my National League team. It's a secondary affiliation.
Well, I had a good night as a longstanding Yankees fan and a Pirates fan. Pirates play tonight. John, I hope you'll be tuning in. I'll be tuning in. John Dick.
I most certainly will be. Absolutely.
John Dick from Civic Science with us during a economic sentiment index week. And John, that's the first thing I want to dive into. We have there's a lot of news with what's going on with the federal response to what looks like a stall in the economy, and the CARES 4 Act that Congress is going to be negotiating this. They started this week. It's going to continue for the next couple of weeks. We saw jobless claims, which we're going to get into shortly, and some companies reporting, and good read on the economy. But our HPS and Civic Science, the economic sentiment index seems to me is confirming what a lot of market participants have been feeling, which is a stall in economic activity, and that's certainly showing up in the index this week, isn't it?
Yeah, it's pretty dark, man. I mean, what a difference a month makes. This most recent reading is the lowest we've seen it since the 14th of April, which is pretty crazy.
Yeah.
But it's really just been the steepness of the decline in the last 30 days. Some of the other indices that were published looking at June sort of talked about June as this rosy month, but most of those surveys sort of ended mid-month, and so we're kind of seeing that catch up now. It's not great across the board, right? I think we also, what probably concerns me, there are two things that concern me most, and we can kind of dive into these a little bit more. One is what appears to be a more calcified negative view of things. It felt a little more wishy-washy probably in May, where I think there was some optimism even when people were in darker times. Now it's sort of like, hey, you fooled me once, shame on you. Fooled me twice, shame on me. There's this sense that like we are actually in this for a longer period of time. And then certainly the other piece of it is the people's view of when and how it's going to end. It gets every single week in our other data, not just in the ESI. We ask people how long they expect this to last, and every week the period of time they expect it to last gets longer and longer, as if we're still further from the end of this thing than we are from the beginning.
Do you get a sense? I think there were a number of the indicators were, about 5 of our 6 indicators were down, right?
Yeah, everything but the housing market, which was kind of break even. It's sort of in the margin of error sort of thing. I mean, I think sometimes we see the housing market numbers lately, and again, this is consumer perception of the housing market, and it feels like they're optimistic simply because they feel like they have to be optimistic about something, right? I'm not sure they've entirely intellectualized why they think it's a good time to buy a home, but they're like, well, it's the one thing I haven't heard the wheels falling off of yet, so I assume it's maybe positive.
In fact, I know like it's coming off bottoms, it hit hard when everything shut down, but it has been coming back pretty powerfully. I mean, housing has been right. It's been with super low rates. I know lots of people are refinancing, and I'm always hearing from people who have been out, looking and buying. And I know it's a hot market today, but there's who knows how long that's going to go.
Yeah, that's for sure. Just in other purchase categories, the other signs that we're starting to see in other data of ours is kind of rising levels of price sensitivity in certain categories that we didn't see in the first quarter, second quarter, I guess. calendar quarter, and just little signs that we know what's going on. I'm sure we'll talk a little bit later about what's going on in savings. Just there's a lot of different triangulated things going on. That also, of course, we know that the stimulus is wearing itself off. We know unemployment insurance is coming to an end. Presumably, I know you guys are going to talk a bit about the next phase of stimulus that could be coming, but until that happens, we've just got a very tenuous consumer group right now.
Yeah. Richard Fairbanks, the CEO of Capital One and the founder of it, since he founded it on conference calls, he kind of just speaks his mind because he owns the banking business. But he was saying, as things stand now, the consumer's okay with the stimulus, but they took a large reserve just in case Congress doesn't come through. They said without this stimulus, the consumer's in big trouble.
Yep. I think the consumer feels that.
Yeah, definitely. It's there's a so you have that hit. You also have a one of the one of the correlations that we've been paying attention to is the JP Morgan credit card data. Yeah. Not so much even on how much people are spending, which is an issue, but where they're spending it, and its correlation with the spread of COVID. So one of the things that they've been able to see and what they qualified as particularly predictive is in the states where you see a high number of in-person credit card use, increase in COVID cases follows. So we're learning a lot about what practices will allow people to get out and do economic activity in safe ways, but there's a lot of work still to be done there. And this look, I think this is a story that if you think of this as a double dip, in some cases it's a first dip for some of these states, but for the country it's a double dip into a stall. Is the states that I think pretty clearly now we can say move too early in trying to resume normal activity without the proper use of masks and distancing and other activities. And so the big question, if you're thinking about what the government response is going to be, is does this happen yet again when we go to schools? We reintroduce sports in schools and other activity in the fall.
We talked about this the last time I was with you guys, and it was a little prescient actually when we talked about the restaurants opening, and we said, that just because you can go into a restaurant doesn't mean that you should. And we've learned so much really fast in the last 4 to 6 weeks about how much more dangerous this virus is indoors versus outdoors.
Yeah.
And when you talk about restaurants, hospitality, entertainment venues, all of these indoor places, those are the ones that you have to fear for the most, because I think what the consumers now figured out is that what we figured out last, whatever that was, 4 to 6 weeks ago, which is just because I can do this doesn't mean I should. And so now I'm not. And one of the more ominous indicators in our data, we ask about when people think they will feel comfortable eating in a restaurant again. Nearly 50% of consumers say it's going to be at least 6 months until they set foot in a restaurant again, right? I mean, that's pretty bleak.
It's pretty bleak, yeah.
Yeah. The other thing, by the way, that doesn't get a lot of attention when you think about the states that are suffering right now or spiking, is it's not a coincidence that they're Sunbelt areas. Who the hell wants to be outside in Florida and Texas this time of year, right? So these hot areas where maybe in the Northeast where people were potentially like inside a little bit more in March when it was cold. Now you've got the reverse happening, where the people who are in these super hot summer states in the summer want to be inside, and again, that's where it spreads. So that pendulum will swing itself right back to the Northeast, and Midwest come October, November if we're not careful. So we do have to plan for some rebounding of this in different geographies.
Yeah, definitely. Well, one thing the move to outside dining is doing is just lots of restaurants everywhere, building outside dining structures. I've eaten in a couple of restaurants now outside, a handful of restaurants. I've enjoyed it. I think it can be done with spacing. It can be done pretty safely. We're not seeing any correlation of outdoor dining and increase in COVID cases. So hopefully that is a sign, again, just learning on how to do these things well. And it may bode well for things like outdoor sports too. Can we resume in certain ways doing, tennis tournaments and golf tournaments and baseball and football, which is of course a big economic engine in the fall as well. And we'll see. I still think there's a lot for us to learn, and nobody should rush into anything. John Fagan, it said like the initial claims yesterday. The first increase in I think 16 weeks. Is that right? I can't remember. It's been a long time. We've had a few months of where the initial claims have come down each week, even if they've been stubbornly high. But going from around 1.3 million something last week to over 1.4 million this week was pretty dispiriting, wasn't it?
Yeah, it was indeed. It wasn't necessarily unexpected, although consensus estimates were still for some modest level of improvement. These unemployment, these jobless claims, new jobless claims, which are relatively high frequency, unlike the non-farm payrolls, which are month by month and have a snapshot of sampling within that month. These come out. The last one was the week ending July 18th. So quite contemporaneous. It was not entirely unexpected. The improvements had been flatlining for a number of weeks. And, the fluctuations had been tight enough so that there were certainly expectations that it could go either way. And in line with our previous discussion, the sense that the resurgence in COVID in various U.S. hotspots ongoing has resulted in a backsliding of economic activity as reopening efforts get wound back, get rolled back, or get paused, as we've seen a variety of different places. Wasn't necessarily unexpected, but still there was the once it hit the headlines, the markets in general have been maybe a little less geared toward the economic numbers recently, because we have so many other things in the headlines. We've got U.S. China making headlines. We've got earnings season coming out this week. So there have been and everybody understands that we have pretty distortionary forces going on. So financial markets haven't been particularly responsive, but we did see yesterday treasuries rallying again, and it potentially playing a little bit on sentiment.
You think it had sent a signal to the negotiators on the Hill?
Well, one would hope that this was part of the message. The urgency level is, I don't think it's necessarily lacking in terms of the frenzied activity. The headlines keep coming out. There's obviously quite a lot of activity in motion, and we did see, despite the fact that the draft Senate plan was supposed to come out this week, has been delayed until next week. We have a relatively large amount of detail that is apparently from that plan, and represents some meaningful progress toward a bill. Obviously, the Democrats think they're going to have to add some stuff to it here, but it's not just the rolling off of the enhanced unemployment benefits at the end of the month. There is a sense that something really needs to be done very quickly, and with this early August House recess, August 7th, I think, when the House is scheduled to go on recess. That's a line in the sand, I think.
I get the feeling from watching it that like we are back in this sort of normal game in Washington. Republicans are trying to get agreement on their plan. They're probably close to it on the contours of it. Treasury Secretary Mnuchin outlined a lot of it yesterday with some of his public comments. the basic outlines are they're trying to stick to somewhere around $1 trillion. There's a possibility that expiring UI benefits, they may come up with some kind of plan to do a plug to buy them some time if there's fear that they're not going to get the plan, the comprehensive phase 4 plan done before they leave for recess in August. That's the expiring benefit. It's expiring enhanced federal benefits happen at the end of July. So there's some urgency there. What the Republicans are talking about to replace that is not unsensible. Some kind of model to get people at somewhere around. You could argue what the right percentage should be. They're trying to get them somewhere around 70% of replacement income, and you can argue whether it should be 80 or 90% replacement income. But the concept is fine. The problem is that you got 50 states and territories with different systems and different abilities to actually implement some kind of modeling into their delivery of unemployment insurance. And so it would really throw a wrench into things. So I don't know how that's going to happen. Just very quickly, some of the other elements. Republicans are trying to stick to around $1 trillion. Democrats are at $3 trillion. We can all presume we're going to be somewhere in the middle on some of this. Republicans do not have money for states and cities. Democrats are insisting on money for states and cities. We'll see how they sort that out. I'm sure we'll have more to talk about on that.
I think the Republicans included a bunch of money for schools, correct?
They do have schools, yeah, because they feel like they're not. If they're insisting, if the president is insisting that that they go back to school, then they want to put some carrot out there. Put some money into the kitty for that, and then targeted PPP is a piece of this. They're gonna. It looks like the intention, at least from Mnuchin, is to have allow a second bite at the apple for particularly needy companies. So if you the kinds of things we've heard them talk about are if you've experienced at least 50% reduction in revenues, that you'd be eligible for a second bite at PPP, and trying to target some of those companies who for whatever reason, especially minority firms that, again, for whatever reason, have not yet accessed PPP, to try to get to them and add a little flexibility for them for smaller and minority-owned firms. So some good stuff in there.
That's a good idea, but I fear if you're at the point where your revenue's down 50% this deep into the pandemic, I think you're just giving up and shutting down.
Yeah, especially with no end in sight, right, Brendan?
Exactly.
I mean, like the whole point of PPP at the beginning, and the one last piece I forgot was another round of $1,200 checks, means tested for, I think, people below $75,000 in household income a year, or something like that. So another round of checks to give a more stimulus boost to the economy. But you're right. Like if you've already if you experienced losses in the range of 50% or more of your revenue, and you're seeing these rolling, increases in, COVID. It's like, even today, while the numbers are still high in California, Texas, Arizona, Florida, Georgia, they're still pretty high, but they're off their highs. Florida and Arizona in particular are off their highs and have started to come down. But we've seen, 15 other states that are seeing a rapid increase in.
Yeah, I feel like that's the story that's not being reported. It's a small state. Like Alabama is in full-blown crisis.
Alabama is Louisiana.
Just the numbers are smaller, so the headline isn't as catchy as compared to, Florida and California. But Middle America is really getting this thing hard, and they haven't really started the efforts to counteract it.
Yeah, so more work to do there. We'll come back. I know we're going to be talking about just what this plan is and how it's going to play out over the next couple of weeks. If you're listening to the Macrocast, let's come back and talk about other facets of stimulus, both here in the United States and what the EU is doing in historic fashion. We'll be right back.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The HPS Civic Science Economic Sentiment Index accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through hamiltonplacestrategies.com.
We're back on the Macrocast. Guys, I think a number of weeks ago, back when people were whacking the PPP program because, too many companies were getting money, but yet the Fed was trying to build its Main Street lending program, and it's built it. And I think what we said at the time was they were trying to let perfect was becoming the enemy of the good, right? They were trying to create this perfect, unassailable program. I think they confused unassailable. It's unassailable. It's also unavailable, right? I mean, no one's actually using it.
Yeah, it's because they're not supposed to lose money on it. So, and in this one, they're actually making a loan. So in all their other stuff where they buy debt or ETFs and things like that, they basically can guarantee themselves in the short term they're going to make money because they're the market. They buy so much of it that those prices are going to rally. Yeah. Here, the Treasury had a small backstop. Then the Treasury has increased it. So the Treasury is in that first loss position, but it's still not very large. So basically what the Main Street lending does is what banks do really, really well. Banks are really good at making mid-market loans. And the Main Street lending is doing the exact same thing, but it's even more complicated with more restrictions to make this loan. So they've made $14 million of loans because it doesn't really make sense to go through all the hassle of taking a loan from the Fed when you can just go to Bank of America or JP Morgan or your local place. So until they're willing to lower the restrictions and the underwriting standards, and more importantly, take a bigger loss on it, I just don't see why the Main Street lending is gonna be tapped.
Yeah, it's a $600 billion program, and obviously at a time when the Federal Reserve is clearly focused on the downside risks of the economy. We're going into a meeting where they're not likely to do any new policy, but to talk about a potential policy shift. This policy shift that they're discussing most primarily is happening on the strictly monetary side. They're talking about enhanced guidance with maybe a yield curve control kind of twist in there. At least it's part of the discussion, but more likely they're going to opt for an enhanced guidance for interest rates keyed off of some of their traditional inflation metrics and so forth. That's probably not likely to be fully baked until the September meeting, but we're clearly getting hints on that front. And they're talking about that they're firmly focused on the downside risks to the economy, obviously, and they're talking about how fiscal, Congress needs to step up and do more. And, at the same time, they've got this Main Street lending program, which has made almost no loans at all. And
which, by the way, I mean, we can be critical of Congress, and we are from time to time. Congress did not exactly shackle them with restrictions on what to do with that money. Congress actually gave lots of flexibility. The Treasury and the Fed have done this to themselves, where this money is not getting out there to support these companies. And it's just that, to me, it's just this, political bias. We saw it with, we saw it with the anger over, Shake Shack getting PPP money, right? It's like anger over Shake Shack getting PPP money. And the thing to remember about PPP money is all of the money is supposed to go to pay workers. That's what, it's the workers. And there are workers at larger companies and workers at smaller companies, but you can have political empathy for the small companies. These mid-sized companies, there's no political empathy for them. And so they're just taking it on the chin hard. And so, so you say, we're going to show up and help, and we're going to help with this program that is just you'd be crazy to borrow from this program. You have to be pretty desperate to go to the Main Street lending program.
I mean, there's the argument that they could make, not to spring to their defense necessarily on this regarding this program, but lending standards tightening over the next few months, maybe the market sort of meets the Main Street lending program back where it is, and the terms that are not so great now are more attractive as credit conditions tighten up over the coming months. They're saving their ammunition. That's certainly possible. But if you talk with a lot of businesses on Main Street, and we discussed the Yelp, I guess it was Yelp's data that over half of the restaurants that closed during the pandemic are closed permanently. I mean, this for the Main Street. I mean, this is the Alamo, right? And you don't want to save your you don't want to save your ammunition when you're in the Alamo.
But the problem is the underwriting standards are really, really strict. They have very strict like debt to income ratios. So the most desperate businesses can't qualify for them currently.
Right. The rate isn't competitive. Plus you have public disclosure. Plus you have restrictions on compensation, and and it's just like it's almost I mean Badgett talked about a penalty rate, and this is like a penalty rate plus.
Yeah. But
the point is, these are companies that are responding to a public health crisis.
Right.
They're doing the right thing for the country. They've got government telling them to shut down. These aren't, we're not talking about necessarily companies that were in bad shape. They were going concern, really successful companies 4 months ago.
Yeah. The bottling company around the corner is not supposed to have a war chest of billions of dollars to ride through a pandemic. That's it wasn't their fault.
Yeah. Right. And states are in a very similar situation. The Fed also has the municipal liquidity program, liquidity facility. That is a very chunky $500 billion program. Illinois has stepped up and taken it. They were able to get funding. The estimates were a full percentage point cheaper than they would have been able to get in the municipal markets. That is meaningful. And this is traditionally been, a stigma attached to taking this money if you're a state. I think it's extremely important to engage for the Fed and the Treasury to be engaging with municipalities and trying to find ways to get this, to encourage this program to be utilized and tapped. If we are going into if the Fed officials are right and we are going into a very difficult couple of quarters for the economy, and on the other side of it, both the Main Street lending program and the municipal liquidity facility are still brimming with funds that never got dispersed, that is an unconscionable failure.
Yeah, and with all this going on, the Fed's gonna bring us back to the gold standard, apparently.
Oh no. Well, look, John's data, the ESI data, says the stall in the economy has happened already.
Yep.
And we're talking about CARES Act funding that we're going to see weeks of negotiation with, and then weeks after that until, say, stimulus checks and some other money's expended, and a Main Street lending program that should have already been pumping billions and billions, tens of billions at least of dollars into the economy. That isn't doing that. And so I get the feeling right now that there's like the urgency should have happened already. We should have responded to the urgency. Now we're late. And now we're in this, Washington dance of negotiating on this stuff and how to fix programs. And we're going to be late again. I think it's going to be a long, hot summer the rest of the way. And we're going to wake up in September really disappointed where things are standing.
Yeah, I totally agree. Both with businesses and especially with the state and local. Like, they don't have the money to pay teachers right now. So without a federal bailout, it doesn't matter whether we want to go back to school or not. We're not going to have money to pay teachers to do it.
Well, and Tony, that September timeline's not entirely arbitrary either. I mean, we will have now come and gone through back to school and back to school retail or not.
Yeah, good point.
We're gonna be staring over the ledge at Black Friday. That's going to be 6 to 8 weeks away from starting, if not sooner. If we don't start writing this ahead of those, the consumer spending is going to be affected in a way that has a ripple effect, as we all know, on the economy. That's could be tragic. So the timing is of the essence, no question.
All right, guys, let's take a break and we'll come back and take a look ahead at next week. You're listening to the Macrocast.
Check out HPS Insights, a regular podcast from Hamilton Place Strategies, bringing you the latest on policy debates affecting the business and political communities. Available on your favorite streaming platforms, including Apple, Spotify, and Google. Tune in to the latest episodes and learn more at hamiltonplacestrategies.com/podcast.
All right, back on the Macrocast. John Fagan. So, again, more historic progress on the EU fiscal support plan. How is that moving this week?
Well, they actually got a deal. It looks like the agreement was for a $750 billion stimulus package that came along with a larger multi-year budget for the European Union. But the real focus was the stimulus package that had a really essential element, a historic element of fiscal federalism. And that fiscal unity is something that had been the Achilles heel of the EU for so long. And this, the specifics of this stimulus bill, that it raises the money through the standard allocations among the various members, but then the distribution of that money is by need. And clearly the ones that need it most are the Southern European states like Italy, who've been hit hardest by COVID. And Italy is in fact going to be probably the largest recipient of these aid funds. That is something that the Northern Europeans have pushed back against for a very long time. Germany and France united to put this plan together and issued the draft in mid-May. That it was kind of a slow notice of around broad markets, but the euro really got going. And flash forward a couple of months, and the euro is up almost 6.5% versus the dollar. In the meantime, the European countries have had relative success in containing COVID. We just got some very encouraging purchasing manager index numbers out of Europe for July. These preliminary July numbers came out this morning in the manufacturing and services sectors throughout Europe. The Europe-wide metrics were much better than expected. Europe's had a good couple of months, and earlier this week they cemented this deal. Clearly, what they call the frugal four Northern European countries: Sweden, Denmark, Austria, and the Netherlands had some pushback. They reduced the number of the quantum of grants within the emergency fund from the original 500 billion euro down to 390 billion euro, which was a meaningful concession, but still that's a lot of money. And
I'm kind of amazed that the Frugal Four really didn't put up a big fight. It looked like they were going to stand their ground, and then they came back the next day and they cut the deal for just a smaller amount of loans and grants. But the 750 stayed the same.
Yeah, in the grand scheme of things, there's a sense that this package is a little bit late and maybe it's a little bit small compared to what the U.S. is doing.
Yeah,
that's fair enough. But
also, Italy can borrow for nothing too, so maybe that played a role in it.
Yeah, I mean, as a political statement, this is an enormous watershed event for the unity of the European Union.
It's a really important point.
Yeah, and we saw Italy this week. They announced earlier this week that they were going to put forward another 25 billion euro domestic stimulus plan. And usually when Italy comes up with another spending plan, it really whacks their bond market. Their bonds rallied, and it was not just any rally. It took the 10-year Italian yield below 1% that day, on the day of the announcement. And so right now it's a very favorable dynamic. We're getting some volatility pickup in global markets, but this has been as I said, a good couple of months for the European Union.
Yeah, definitely. Do you have a good feel for how they're going to use these funds, like how they will be distributed at the country level?
So Prime Minister Conte in Italy came out and said that he expected the combination of grants and low interest loans to Italy from this fund to top 200 billion. Wow. Exactly how that money is spent, I think there are going to be some, there's going to obviously the Northern European countries push for some oversight and some reform movement alongside, and there's a sense that they can withdraw or withhold the money if some cooperation on the reform side isn't being met or governance isn't being met. But other than that, I think it's basically pretty much up to the local governments where that money is.
It's going to be. I think it's going to be really interesting. I mean, look, I'm Italian American and spent a lot of time in Italy, and no one should be under any delusions as to how much they need this support and why it's necessary. And this is a smart thing for the EU to do. No one should also be under any delusions that it's all going to be spent efficiently and it won't be, cases of corruption and back dealing in certain places. Like look, we've seen that. We saw it in certain, people trying to do it with the PPP program here. And I can tell you from someone who's spent time with local governments in the United States, like, if there's a lot of money available, human beings will find ways to get it, not always on the up and up. That's the same thing's going to happen in Italy, and there will be opportunities for some black eyes for Italy, but it is the right thing to do for the overall European economy and certainly for these hard-hit communities. What do we have? What are we looking at next week?
It's a very busy week in terms of data. We get a number of surveys, consumer sentiment surveys around the globe, but as we kind of saw with John today, those are backward looking. You really, if you want to know what's going on, you need to look at the alternative data sets. But we have a Fed interest rate decision. We have GDP, second quarter GDP, both for Europe and the United States. The United States is expected to be down 1 million %. And then we also have U.S. In the U.S., probably the big one. Well, the GDP number is important, but we know it's going to be awful, so it doesn't really matter whether it's down 40% or down 37%.
Yeah, it's a big number. Yeah.
Yeah. But so we get the personal income and spending, and within that you get the inflation numbers, the core and headline PCE. So those will be the big ones for the week.
And any particularly important earnings next week.
Yeah, so we kind of make it through all the financials, and now we're getting bigger into the tech giants. So that'll be the focus for next week.
One thing I think we would have been talking about next week was the big four tech CEOs were supposed to testify on Capitol Hill on Monday. That's now being put off for a few weeks because of the memorial ceremonies for John Lewis and other complications. So we'll come back to that later in August. But lots of news next week, and then following week we're going to look ahead to another non-farm payrolls report and see if we get any more evidence on where we are from that data.
Yeah, exactly. Based on the claims data that we got on Thursday, a lot of the forecasters are expecting a 0 to a negative number actually for July.
Hey guys, great show today.
Yeah, it was a lot of fun.
Yeah, have a fantastic weekend. Thank our friend John Dick, who was with us from Civic Science today. You should check out his site, www.civicscience.com. John Fagan, Brendan Welsh from Markets Policy Partners, and Tony Fratto with Hamilton Place Strategies. Thanks for joining the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.